What is the history of the market telling us about the direction of the market for 2025? Stay tuned. Well, thank you so much for joining us this week for episode 224 of Note School TV. And this is the monthly update. Yes, folks, it is the end of January of 2025, and it's been a month. And now Eddie and I are going to kind of go over what we're going to see. But before we do that, let's go ahead and like this episode. Yep. Hit that like button, share this with your friends, share it with your business associates, share it with everybody you know, right? And then number 2, if you have not already subscribed to Note School TV, make sure and do that. And number 3, hit that bell notification. Yep. Boom. Hit that bell notification so that you will be notified when we go live. When? Every Wednesday at 11:05. If you'd like to know more about what we do at Note School, simply go to noteschool.com/TV. Again, noteschool.com/TV. So now let me bring on, founder of Note School, Chief Visionary Officer, all around good guy, Mr. Eddie Speed.
Good morning, Joe.
Good morning. How are you?
Well, I agree with you. The history of the market should be telling us the direction of the market entering into this year. And for those of you that watched an earlier episode of Note School TV a couple of weeks ago, we had Darren Bloomquist, that is the data guy for auction.com. And we spent a long and so we're bringing more of a global picture. And I think Darren brought more of a lot of very specific picture of the market. So I think it'll tie together.
Yes.
And Joe, I will tell you that I have been on more stages in the past 30 days than I have been on in a good long while. And that is because the market is changing in our direction. And I think what we're telling people is now becoming a truth. I think it was true a year ago.
Yeah.
It's becoming a truth to them now. So we're going to try to tie that together and talk about that. Yeah. And so you've done a great job of putting us a magnificent presentation together. So let's roll the dice, baby. Let's do it.
Let's do it, man. So Eddie, guy that I know, said it's better to do the right thing at the perfect time than do the perfect thing at the wrong time. Who was that?
That was a caption from a podcast that I did not long ago, and a guy grabbed that. And I would say to you, Joe, is the next thing I would say in conjunction with that is just because something did work doesn't mean something will work now. Right. And I think that's the mindset that we're seeing, and particularly people with the rental property mindset. Like, I don't care what used to be, right? A wagon used to be the best way to get to town.
That's right.
Right. And so all of a sudden things change. And so we believe the market's changing. And we'll talk about that as we kind of get to that. But I think there's a mindset here. There's a shift that people are seeing things differently. So do the right thing in perfect timing. Let's just stick with that.
We'll go back to the old saying that Henry Ford said, if I'd asked them what they wanted, they'd have said faster horses, right? So, different cycles, different opportunities, what we can expect. And I think that's what we're looking for today in this episode as we go through this.
Yes, sir. That's it.
Sir. Eddie, talk about this just a second.
Well, I tell people that what Note School is the best at is financial modeling. And I don't know if you've ever seen this experiment, Joe, but it's where you have the glass jar, right? And you have a little thing of sand and a little thing of bigger rocks and a little thing of smaller rocks, right? And if you pour the sand in the bottom and the little rocks in second, and then the big rocks on top, it's going to look like the picture on the left. They're not going to fit.
They're not going to fit.
But if you take identically the same ingredients and you put the big rocks in first, and you pour the little rocks in that fill around the big rocks, and then you pour the sand in on top of that, and it fills in around that, it looks like the picture on the right. That's what I believe that our financial modeling is. The numbers are in your calculator. It's just assembly. How about that, Joe?
It's just how you put the parts. It's the puzzle pieces that we always talk about.
Yeah.
Let's jump into the housing market. So, Eddie, housing market hits a key level not seen since 2009. And the number of newly built homes on the market is at the highest level since 2009. We remember what we had the remnants, or we're still going through. There was a lot of homes for sale in 2009, newly built for sure.
Yes, sir.
And then, go ahead.
Well, I mean, this is the home builder debacle, and you know, Joe, I guess we're kind of blame. We pick on everybody, right? We pick on multifamily, we pick on home builders. No. We are saying for you to have a risk blueprint, you've got to constantly be inserting what the risks are in the market, and a lot of these risks are not commonly known.
That's right.
This home builder inventory is a problem.
That's it. And then you go right back, Eddie, to the resale market, right, which is current homes, saw its worst year since 1995 in 30 years. So we get.
I talked to a friend that is a hedge fund guy, a long friend of mine yesterday morning, Joe.
Mm-hmm.
And he says, you know what we think? We think we're going to see a decline. I said, well, you know, Darren Bloomquist was on with us a couple of weeks ago, and he basically said that. He said, well, we've learned that when some people say it's going to break right and some people say it's going to break left, it's probably going to break in the middle.
There you go. yeah, absolutely. We know that 30% of home builders, according to the National Association of Home Builders, cut prices in January on their house, and 61% of offered incentives for the same organization. And Eddie, that is up from 48% November, December, as far as the incentives. And that doesn't include the buy downs on the mortgage rates as well. So, yep.
So we have the best data. We have the best data that we've ever had in the history that I've been in this business.
Yeah.
It's available to us. The story is out there. The weather report is right in front of us.
Yes.
All we got to do is turn on the right channel and pay attention.
That's it.
This is what Note School TV is trying to be for you once a month. We're trying to be the right channel to give you direction so you can make good decisions.
Amen to that.
There's a caution flag here, folks.
Yeah. So, Eddie, we're looking at Florida. And this is down a bit from what it was back in the fall, but still, you've got Florida and Nevada that is really, you know, the two highest. You know, of course, we got Georgia, you know, Texas at 22%. So this is the increase in housing inventory, houses that are literally on the market. So,
well, Joe, here's the good news. Okay. North Dakota is at 0.
Yeah. What's the difference in North Dakota and South Dakota? Well, I shouldn't say that, right?
I don't know. They're 20% different. So,
I know, right?
You know, let me say this. This chart was looking worse. It did tighten up towards the end of the year, but we're looking at an average of about 122%, and that's days on the market. And you can read. You can go to whichever report you want to go to, whether it's Citizens Advisory or whether it's Darren Bloomquist or whoever it is, and they've all got their interpretation.
Yep.
This tied with home builders means that we are entered into this market with a lot more inventory than we have had in the past. And we are not looking at a big change in rates. And so I think that this means that you need to kind of have a heads up about residential real estate.
That's it. Just be aware. Eddie, it boils down to affordability. And I pulled this from the Pew Research Center. They're great, by the way. And this is just the cost burden of housing, depending on where you live, obviously. And if you are a renter, nationally, 49.7% renting households are cost. That's 1 and 2, right? That's half. And then we get over here on all households, which includes mortgages. And we look at, you know, of course, California, and we've got Florida and Texas. And that's, you know, that's in the 30 to 40%, 30% to 39.9 to be precise. So, you know, that affordability thing, that elephant in the middle of the room, that's what it looks like.
It's the ceiling. And I think it's the ceiling that a lot of people forgot when they really looked at, hey, we're going to go, you know, rentals are the perfect thing to have an inflation. And the answer is when houses doubled in price and expenses went up by 60% and rents but went up by 20%, and they couldn't go up anymore because it was the ceiling of what people could afford, then all of a sudden this is part of what brewed the tea for our new story in the industry, which is, the notes are a far different angle than they have been in the past relative to alternatives. And we'll continue and kind of build that out. But that's where we are, Joe.
Yeah.
And, we're not making the news. We're just reporting it. Right, Joe?
We're just reporting it. And this is an interesting stat here. And this came from Darren a few weeks ago. And so average property payment is up 52% since 2019. And Eddie, this just tells the story of the principal payments are up 17%. Interest is up 15%. We look here. Taxes plus 18%, and there's the daddy right there, and that's at 52%.
Joe, and that's a guarantee that when you pay that much more in premium, that you're going to have no fight with the insurance company in getting the claim paid.
That's it. You won't have a fight, Eddie. I promise.
Oh, wait a minute. You're in a settlement with them right now, aren't you? Down in Florida?
Well, we just reached a settlement. I'll share it with you later.
Well, hey, there's 50,000 lawsuits with insurance companies down there. So, glad you got yours knocked out of the way.
For sure.
All right, let's roll on.
See. Let's talk about the banks. Interest rate on outstanding mortgages. This is kind of interesting because this was at 73% of U.S. mortgages in the U.S. were less than 5%, and now that's down. Let's see, it's 12.2% decline from the historic level when 85.5% were less than 5%. And Eddie, does this show an indication of people are finally realizing that, hey, this is the new norm? The 7% or 6.5%, whatever it is not. This is what it should be or what it is, right?
No, I'm having a phone call yesterday with a mega seasoned banker that banked mortgage bankers. He loaned money to mortgage banks, the biggest in the country.
Right.
And he's been an executive in that world for a long time. And he says, apparently the younger people found out that 4% wasn't normal, right, that the real norm is in the 7s and has been an average for the last 50 years.
Right.
And the answer is, I think that's absolutely a truth. And by the way, then all this insurgents and seller financing, these aren't like super low rate mortgages. They're so this is normal. And all of a sudden, the mentality is people see it's normal. And people say, what's normal? I think history is normal. I think short-term history isn't always normal, but you stretch something out over decades, now all of a sudden you've got what's normal. And the average rates for mortgages over the past 50 years is just about 7.5%.
That's right. That's right. So, and so finally people are letting go of that lock on that mortgage. They're having to sell. And so we're going to see this continue to move in the area where this continues to go up.
Got
as
it.
far as that goes. Yeah. All right. So Eddie, here we go. This is the rate as of 6:30 yesterday morning on Tuesday morning. 30-year fixed rate, APR 7.09, and the 30-year fixed, the interest rate is 7.04. That is what it is according to Bankrate.
Joe, I want you to look at the very top one, which is the 30-year fixed rate, and go to the annual percentage rate, the real rate.
Right.
Right. And then go to the bottom and that 5-1 arm.
What happens from 6.47 to 7.09? I saw that. I looked at it. Yeah, is that right? And then I did a little more research. And yeah, it's right.
Yeah, it's funny that everybody thought the arms were going to be the fix for this, but it turned out not to be true. And so anyway, Joe, I would say to you that the projection in the market, if you look at 10-year T-bills, and we discussed it with Darren the other day, the direction of the market is that we're not going to see really a slide in interest rates. And once again, that's what the forecast looks like at the moment. There could be a rainstorm come in that's not on the forecast yet, or the sun could come out way better than people think.
There you go.
But I think at the moment right now, this is what our future looks like this year.
So, Eddie, we're talking about the mortgage applications. As the headline says, they don't have much to lose as new apps continue to fall. And, I put it into perspective right here where it says, 3.1 million new apps in 2022, and we're at about 127,700 today. So, that's what it is.
I don't feel like there's any market condition that's going to lead us in a different direction.
No. Time will tell. So, Eddie, we had this just updated this, and if we look over here, it's 95.9. It had ticked up to where it was right at 100 as far as the index, and now it's there it is. It's ticked back down a bit.
Joe, as long as delinquency in mortgages and newly originated mortgages or freshly originated, like I call it in the last year or two,
right?
As long as we are seeing a little increase in delinquency, you can about suspect they're not gonna loosen lending criteria. No. And once again, this is what's driving it. And I think that as we look at this year, mortgage bankers are not making their loan production's down, and they can't make a bunch of mistakes on what they're originating loans on. No, and they're not fixing to lose their mind, because mortgage banking is the underwriting is being dictated from the top.
Right.
Right. Not the little operators dictating what the national market does. The national market is dictating the direction, and this just seems to be where we're going. And so it's going to jig jag back and forth. If it's up 5 or 10 points, it ain't going to make any difference.
Not at all.
Right. Most people are left behind. That's why you're seeing the production as low as it is. And of course, rates.
And right.
Not just rates. It's also underwriting.
Yeah.
All right,
Eddie, there's I didn't put it in here, but the new credit card debt rate is a $1.7 trillion. So there you go. So here's where we are. Why does all this matter, Eddie?
Well, the left is the market we've been in. Go back, Joe, just a second, please.
Yep.
All right. So the left is the market we've been in, and now the right is the market that we're in, and we're finding all kind of opportunities in creative financing, particularly seller financing, in areas that we've never considered it.
Yeah.
All right, so go to the next slide, Joe.
Yeah, let's talk about
it all the way in there. Like, market timing is in the middle of this cycle. So, Joe, above rental cycle, I want you to put a number in there, and I want you to put $1,000, right? Just write it in above rental, right?
Okay.
Meaning that if you're collecting $2,000 in rent, you're netting $1,000 because 50% of your money is going out in expenses. Okay.
So
that's $1,000. We've now modeled an excessive amount of these, and I'm speaking to crazy sophisticated offices, top realtors in the United States, top real estate investor groups, masterminds. It's on a weekly, almost daily basis that we're teaching this now and showing them case studies of all this. If you're netting $1,000 on a rental house, you take the same house, and Joe, above the note cycle, put $3,000. It's the same house. It's one of them is seller financing, and the other one is renting. That's the net income.
Yeah.
That model has become a truth. You make 3 times the income on renting on seller financing a rental versus keeping it as a rental. And this is changing the landscape of how people are looking at rental houses.
Yep.
And we're kind of at the spear tip of this. We've been saying this, Joe, for a while.
Yeah.
But the market has now settled in, and people are realizing this is a truth.
Yes.
And so this is something that is a gigantic market trend. And with rates looking down the gun barrel of where rates are going, and look at where financing's going, and looking at how tight credit is, and looking at expenses. Joe, if you have rent houses, is your expenses fixing to drop?
No.
Okay, your expenses are more likely to increase than your rents. Is that true?
It's 100% true.
Okay, well then this is only going to get worse, and people say, when's it going to get better? And I'm like, I don't know, but I know this has been a truth for direction the market's been going for a couple of years, but now all of a sudden people are tired of not making money and aggravating with rentals. Hey, have you considered seller financing? And I'll bet you we can help you with that.
Absolutely. And I tell you what, a lot of our membership are popping in there and seeing that now. So yeah, for sure. Let's talk about commercial. So Eddie, cities where asking rents fell the fastest in 2024 multifamily. Well, there's our old friends in Austin, Jacksonville, and on down the list there. So, what do we have? Just have one in Texas and 3 in Florida. It's interesting here in Florida, Eddie.
Well, the answer is that, I know I sent you another article about how that I'm surprised that Denver's not in there, because Denver apparently has hit a real crash. Like Redfin didn't report that, but Denver's apparently hit a real kind of a crash in the last 6 months.
They have,
and that's kind of outpaced the other losses. So maybe over a year they're not that bad, but it's just, the bottom line is this, Joe: we've hit a ceiling.
Yep,
we've hit a ceiling. It is what it is. We're having more rentals come on the market because of this impact of the construction of multifamily, and it's this is the direction it's going. So rents are flat at best. And I think in most markets, Joe, that we can say rents are on the decline. That's why we kind of modified it and say rents went up about 20%. They probably went up more than 20%, but now they settled back in. And we're probably looking at, before the virus started, we're looking at an average overall of about 20%. There's going to be micro markets that are going to be different.
Always. Yeah.
But overall, what we're saying is a truth that is causing people to rethink their position.
Yeah.
Okay.
All right. So here's TREP's report. This is the TREP's Commercial Property Price Index, and again, we look at multifamily. Price index is down 2.53 quarter over quarter, year over year, 8.38. And then lastly, the 2022 Q2 to 2024 Q3, which is the latest data, almost 17%.
Joe, are you saying that multifamily went down 17% in value last year?
In the last 2 years. That's what I'm saying.
Last 2 years. Okay. Yeah.
Yeah.
Now, everybody knows about office, right? And the trajectory, because Wall Street Journal gave us an article, in late summer last year that said that their prediction of where the market is going is the two most extreme were multifamily and industrial.
Yep.
And industrial is definitely sitting on a big problem, although it doesn't seem to have happened yet. People think it's going to happen. Multifamily, for people to look at multifamily going down in value, there's some people, Joe, that are so perplexed they can't even think about it. Because we became in a trance and thinking that the multifamily was going to go up like a hockey stick and nothing was going to change it. And the answer is there's just no data that supported that. And Joe, we've been on this campaign for 2 years. Am I right?
You are absolutely correct.
All right, let's rock.
We got rents down, we've got prices down, and we've got expenses up.
What did Darren say the other day? I apologize for being pessimistic.
Yes, he did. I forgot about that.
And we are being pessimistic.
Yeah.
But would you rather us do that, or would you rather us just act like, oh, there's no storm coming? Oh no, there's no storm coming at all. It's all going to be blue skies.
Yeah.
The people that make the best decisions and informed decisions are absolutely people that know what's going on.
That's it.
Then you can make good decisions.
There you go. 3-year cycle. We see multifamily special servicing, meaning they're moving from regular servicing because they're paying on time to special servicing, which means that, well, they're not. 5.71 in August, and then up to 18% in December, or up 18% in December. They were about, in November, it was about 15%. So that's going this way. It's going up and not down. So
like it.
Yep. So let's.
I mean, I don't like it, but it is what it is.
It is. Yes, it is what it is. I mean, just call them as we see them. Non-performing loans. So actually, Darren had showed this when he was on 2 or 3 weeks ago. And Eddie, I just wanted to show this piece here, and it's the 2.217837 is the number, which is a little higher than what we had been looking at about 1.937. So I updated this as well. So we're at, there you go.
Okay, so Joe, this shows what we talked about when we interviewed with Darren, and we said there's 1 million loans in the black hole.
Right.
There's about 750,000 loans that are not severely delinquent. Call them 120 days or less.
Right.
There's 250,000 loans that are in foreclosure.
Mm-hmm.
Right. That leaves about 1 million loans that are in no man's land.
Just hanging out there.
Just a tick over 1 million loans that are in no man's land. The loans that are delinquent are 1,300 days average delinquency that are in foreclosure.
That's right.
Right. The loans that are 90 plus days delinquent, circle that number, Joe, 522. That is the days delinquent for Joe, over 1,400,000 loans.
Yeah.
What?
Yeah.
There's 1,400,000 loans that are 522 days delinquent. Mm-hmm. That's why I'm saying that just because they're not listed in the foreclosure bucket, there's going to be a consolidation and a dump of these assets. Eddie, what month? Eddie, when is this finally going to happen?
Get out the crystal ball.
What's going to happen to Bitcoin in the next 4 months? Okay. I don't know. And I don't know when they're going to hit, but I can tell you right now that there has become a lot of talk about it in the mortgage servicing world. And I'm talking to people in that industry all the time. And everybody agrees with us that this pin-up inventory of loans it's going to start spilling over. It's going to happen. The only weird thing that could push on the market, Joe, the only weird thing that could push on the market is additional inventory.
Exactly.
Of real estate, because these loans are either going to get sold before they get foreclosed. The property is going to sell before the loan gets foreclosed on, or it's going to become, bank inventory, REO, right? And so all of this is like doing, and by the way, I'm going and speaking to an REO specialist realtor group here in about three weeks in California.
Good.
And so I'm speaking to a lot of groups that are realtor or specialist realtor oriented. And I'm just telling you that we're all seeing it the same way.
Exactly.
Okay?
Exactly. All right. Well, again, we'll show this for the last time. Maybe we'll just keep showing it because we're proud of it. But Colonial Funding Group, best distressed debt buyer in 2024, voted by you guys, our fans from noteinvestor.com, Note School TV for the fourth year. Yep. We're number one podcast, and then Note Expo. We know Note Expo is great. No brag, just fact. And it's the fourth year on that as well. So, yeah.
Well, we are honored to win this. We've won these awards multiple years, and we're grateful to get one more year under our belt and say we won it. Joe, we are really trying to message in the market the things that we think matter. Joe, great job today. Ton of data. You got us inside of 30 minutes. You knocked it out. And I think it's what our audience needs to hear. I'm gonna let you close us out as to kind of telling people if they want to get some information about doing this. Let me say this, guys. What are we teaching today? We're teaching financial modeling.
Yes.
We're showing people how to take that glass jar and put in the right things in the right deal at the right time, so that to make deals work in other ways, otherwise they don't work. And so I think maybe the analysis, Joe, of the glass jar and the rocks and the sand, I think it's become relevant to people because they're seeing it. A lot of people that have been in the multifamily, in the rental property space, particularly single family, a lot of people are kind of coming in saying, show me this, like, show me how this works. And we're showing them, because this 3X math is such a striking pattern. And I talked to a very high level Wall Street guy in the past day or two, and he says, and I mean, this guy, Joe, is insanely informed.
Yes.
And he said, send me that modeling, Eddie. What you're saying is like a market shock that I don't think everybody's catching.
It's the mic drop at the end.
I've sent that information to him, and we're happy to share with you guys, and anything that we can do to kind of help give you a direction of that. We're not trying to make the market different than it is. We're just trying to call the market the way the math's driving us.
Just what the numbers are telling us.
Joe, I'll let you close us out, my friend.
All right. So, guys, thanks a lot. That winds up our market update for January. We look forward to seeing you next week, same place, same time. And we will have episode 225 of Note School TV. Thanks so much. Again, if you'd love to know more about what we do at Note School, simply go to noteschool.com/TV. We will see you next week. Thank you so much.